All right, let's just have another look at this minimization. So of course, what you want is also to somehow know where the result is, right? So you do res equals minimize. And so what you can do is you can actually plot at the point where your best value is. So we go res.x and res.fun, which is effectively the function value. And we plot this as a red dot. And there you go. This is your minimum point, right? So res is effectively the result of our minimization, which we had a look at before, here. See, this is res.x, it's this one, and res.fun is this one. So this is how we effectively get the results of this optimization. Okay, so what we really want to do is figure out what is the best value in our portfolio. And that's a little bit more complex because now we've got 3 weights that we need to optimize, but the optimizer can do that as well. What we need is basically, see this thing here, this function, that's called the objective function. Yeah. And what do you know what we actually want to optimize in our portfolio? I mean, obviously you've done it before.
Yeah, I mean, we want to have the highest Sharpe ratio.
That's right. So the Sharpe ratio, that's our objective function. That's what you call our objective function. And the function values are our weights. Yeah?
Makes sense, yeah.
Makes sense?
Yeah.
Okay, so let's just see if we can do this. So we've got our HF here. And then we just create reds again. Reds equals HF dot close dot PCT change. Yeah. So that's our returns. So what we can do now is we can obviously see what it looks like if we equally weight them and put them in a portfolio. So we can go reds dot mean axis equals 1. Yeah, so we did the average across the rows, then the cumulative sum of that, and we plot that. So that's interesting. That's our portfolio. Why do you think we see that?
Because of crude oil, I guess.
Yeah. What was the issue here?
I'm not 100% sure, but I think like there was this change globally with like, I don't know, Saudi Arabia's like dumping the petrodollar and something like that. But I'm not 100% sure.
Yeah. Actually, it was Saudi Arabia, or it was basically oil didn't really, there was just no more storage for oil. Oil storage was running out. And so there was no buyers for oil anymore. And people were desperate to get rid of their oil contracts. And they would actually sell their oil contracts, like not just for a loss, but they said, if you take my oil, or if you take my oil contract, I give you money because, otherwise, if they didn't, they would get physical delivery of the oil, but they couldn't store it. Like they were just traders. They didn't actually ever intend to get it. So they were so desperate that they said, please, here's my oil and you give me some money if I give you, I give you some money along with my oil. The prices were negative. So let's just plot this for a second. Oh, I think we need to do dot close. So yeah, that was a really serious problem. And you can see this here. It actually went down to around negative 40. Yeah. So it's not really a fantastic test for this optimization because of this. It just, is a little bit crazy. But one thing we could actually try is instead of this, there's also gasoline futures. They're called RBOB gasoline, and then their ticker symbol is RB. So let's try those because it might be a little bit friendlier than oil. Just, you see this, it's better. It's just for demonstration, but, And so let's see what the correlations are. And they're like, 15%, 28%. So they're actually quite a bit higher correlated with each other than the other stuff. But, nevertheless, let's have a look. Oh, hold on. We haven't got the returns yet. And so look, this is what the returns are. So, we don't know yet whether that gives us anything good, but we'll soon find out.